Hi everybody, in this video I'm going to be showing you my hybrid trading model. Now this model is very simplistic and it's suitable for all types of traders. So you could be a swing trader, a day trader, or even a scalper. I'm going to show you exactly how to do this in a few simple steps, so make sure you stick around till the end of the video. I'm going to give you examples of both higher time frame trades and lower time frame trades, and I assure you I'm going to answer all the questions that I've been getting so much recently, and I think this video is going to be really impactful and change a lot of people's perspectives on how to trade the financial markets. Now, for those of you who don't know me, let me briefly introduce myself. My name is Ara. I've been trading for about 7 years now, and I started an organization called Currency Pros a few years ago. And we've had the pleasure of working with thousands of traders and helping them along in their trading journey by providing tools and education. Let's get right into the strategy. I don't want to add any fluff to this video, so let's dive right into things. I'd like to direct your attention to the top right of the screen where you'll see my entry checklist. Now, this checklist is a function of my custom Currency Pros indicator for TradingView. This is a private indicator for members only, and one of the main features is this checklist. At the very top, we have a premium and discount gauge. You can set the time frame to whatever you like. When I'm swing trading on the 4-hour time frame, I like to set the premium and discount gauge to the daily time frame. And basically what that tells me is that if the daily is in premium, I should only be looking for selling opportunities on the 4-hour time frame. Vice versa, if the daily time frame is at a discount, I should only be looking for buying opportunities on the 4-hour time frame. This is what I like to call higher time frame alignment, and it's actually the first item on my checklist. Now, I'd like to clarify, this isn't 100% necessary. There are plenty of high probability trading opportunities without having additional higher time frame alignment, but it certainly helps you be on the right side of the market more often than not. Through extensive backtesting, we have noticed that there is an improvement in win rate when you have that higher time frame alignment. I'm just going to briefly go through the rest of my checklist here because this is literally as simple as my setup is, and it is applicable to multiple different time frames. So we're going to go over that in just a moment, but let's get through the rest of this checklist here. The next item is a liquidity sweep. Now, a lot of people get confused by this. A liquidity sweep is basically a false break of structure. Now, let me quickly annotate where the liquidity sweep was within this recent range here, and it would be this candle right here that swept liquidity from the previous high. Now, there's a lot of debate in the trading community whether or not liquidity actually does rest beneath major highs and lows. I'm not here to argue either side of that. I'm just going to show you what works for me and what is part of my strategy. So basically, this high right here, if there were to be a continuation of this bullish structure, we would see full candle bodies closing above this previous high. But instead of full candle bodies, we see that this candle just printed a wick and then quickly rejected in the opposite direction. Now, as it pushed in the opposite direction, it created an actual break of structure because we see multiple full candle bodies closing beneath the previous low. The Currency Pros indicator has gone ahead and automatically annotated the break of structure for me, so I don't have to place it. It usually does the liquidity sweep as well, but I think I have that turned off right now. Now, the break of structure that I just mentioned is part of the next entry criteria on my checklist. So, directing your attention to the top right of the screen once again, the next item is BOS plus imbalance. So that's a break of structure plus imbalance. We've already got the break of structure identified. Now, an imbalance, most of you are going to be familiar with this. It's also referred to commonly as a fair value gap. That's what we programmed into our indicator as well. It says FVG for fair value gap. You can see a few of them printed within this range here. And basically those two terms, imbalance and fair value gap, are quite interchangeable. Everybody used to call them imbalances, and then all of a sudden everybody started referring to them as fair value gaps. So we decided to please the masses and code FVG into the indicator instead. But regardless, it's the same thing. It's basically a gap in price between three candlesticks. So analyzing the first one here, we have this candle right here, then we have this candle in the middle, and then this candle beneath it. Now, where the FVG box is printed there, that's the gap between those three candles. Between the low of this wick here and the high of this wick here, there's a gap in price. Now, again, there's a lot of debate back and forth whether or not that these gaps in price are actually significant or not and what they represent. I'm not here to debate any of that or make any points about it. I could care less about why things happen in the market. I just pay attention to the patterns that do occur in the market, because when you can recognize those patterns, that's how you can take advantage of them and actually trade. So regardless of why these fair value gaps print on the chart, what we do know is that price reacts to them more often than not. And that is why I like to pay attention to them, because as price retraces into those fair value gaps, there's a high probability there's going to be a reaction from it and then a reversal in our favor. Now that leads me to the next piece of entry criteria on the checklist, which is a 71% retracement. I'm going to clear up a lot of questions here because I do get a lot of concerns about how I utilize the Fibonacci retracement tool. First things first, the Fibonacci retracement tool is not some sort of magical holy grail indicator. The way I use Fibonacci is literally only to frame my trade. That's it. The Fibonacci is not a strategy in and of itself. It is simply a measurement tool. And again, I use it to frame my trades. So what do I mean by that exactly? Well, taking a look at this short position tool here on TradingView, you can see that I like to have my entry price at my retracement level, which I've chosen as 71%. I then like to drag my stop loss to the high of the Fibonacci and put my take profit at the low of the Fibonacci. Now, thankfully, another amazing feature of the Currency Pros indicator on TradingView is that it automatically prints these Fibonacci ranges for you, so you literally don't have to think about it. We've taken a lot of time to code this meticulously, so it prints from these major swing points, and it's very accurate. Now, regarding the retracement level itself, yes, I choose 71%. I feel like that's a good reaction point, and it also gives me a really good risk-to-reward ratio, a healthy risk-to-reward ratio. But you can choose any level that resonates with you. If you find your backtesting results are better at 62% or 79% or anywhere in between, really, then all the power to you. For me personally, I like 71%. That gives me a consistent risk-to-reward ratio of 2.45 every time. Let me just adjust this real quick. There we go. 2.45 risk to reward ratio. So that means every dollar I'm risking, of course, if it's a profitable trade, I get basically 2.5 times that as a return. Now, one thing that I've realized over extensive backtesting is that if the Fibonacci level lands on a fair value gap, that significantly increases the probability of success with these trades. So it's actually a very big confluence for me that this 71% lands on a fair value gap, which in this case it does. Now, that's not to say that if it doesn't land on the fair value gap, it won't be a successful trade. There are plenty of instances where that does happen. But me and my team, through automated backtesting of 10 plus years, have seen drastic results when the Fibonacci number lands on the fair value gap. So in terms of the trade setup itself, this is literally all there is to it. I use this very simple checklist. I can stay on one time frame. I like the daily time frame, the 4-hour and the 15-minute, but I only execute trades on the 4-hour and 15-minute. I use the daily as a higher time frame gauge, but the fact that it's automatically programmed into my indicator, I don't have to go to that time frame at all. I can stay on my execution time frame. So the majority of the time, I'm just sitting on the 4-hour time frame waiting for setups just like this to occur. Now, speaking of which, let me play price forward using replay mode on TradingView. This is a trade that I personally took, as well as many of our community members. So let me go ahead and play it forward and you can see how it turned out. And also pay close attention to how the Currency Pros indicator adapts to real-time price action. And right there, the entry would have been triggered. Instant rejection, very minimal drawdown, almost non-existent drawdown. And there we have it. So a very profitable trade, literally no drawdown. Another feature of the Currency Pros indicator that's appearing here is the equal highs and equal lows function. So that shows where resting liquidity is in the market. And as you can see, as price trades lower, a new Fibonacci range is being printed. And if I just continue, you'll see that that range continues to adapt until there is a significant retracement. After there's a few candles of retracement, that Fibonacci tool locks in place and you can start analyzing whether or not it's a good trading opportunity to get involved in. Let me show you one more example of a higher time frame trade using this strategy and indicator, and then we'll get into some lower time frame trading. All right, here we have another example of the strategy. This one is on Euro USD on the 4-hour time frame. Now, once again, I'd like to draw your attention to the checklist at the top right of the screen. This time, however, there are some negative confluences, so let's get right into that. First things first, the daily time frame is currently at a premium. Now, as you can see, if I zoom out on Euro USD, price is very overextended to the upside. That's a bit of a warning sign, but at the same time, you don't really want to go against such a significant trend like this. So it's highly unlikely that we're going to all of a sudden see a massive reversal to the downside without any sort of fundamentals factoring into play. So just based on technical analysis here, we'd like to continue the trend, right? So what I'm going to go ahead and do is open up the indicator settings and scroll down all the way to the checklist. And I'm going to deselect higher time frame alignment. Now you're going to see how that applies to the checklist here. There's now an X next to higher time frame alignment, and my trade score went from 100 all the way down to 75. So this is not exactly an A+ setup. Just to clarify, that doesn't mean it's a bad setup. It just means that maybe you should adjust your risk accordingly. You should be aware that it's not a perfect setup, but you do, of course, need to use your own discretion as to whether or not you're going to get involved in such a setup. Now, let's zoom in a little bit closer and discuss the other technical aspects of this trade. So the next thing on the list is a liquidity sweep. Now, we actually don't have that either. In fact, we actually see equal lows here. The Currency Pros indicator has automatically annotated that on the chart. And what that means is that there's potentially resting liquidity here, which could be a draw for price to trade into. So instead of reacting to our 71% level here, we could see significant drawdown and then eventually a loss because price wants to purge liquidity from these equal lows. So once again, I'm going to open up the indicator. I'm going to scroll down to the checklist and deselect the liquidity sweep because that is not present. In fact, we have the opposite, which is resting liquidity. Now you can see we have a significantly reduced trade score. We have 2 of our confluences missing and we have 2 that are present. Now up next, we have break of structure plus imbalance. We do see the break of structure here plus many imbalances or fair value gaps, if you'd like to call them that. So we can leave that checked. Next up, we have 71% retracement. That retracement actually lands on a fair value gap. So it's a very positive confluence, as I discussed in the previous example. So there are definitely some risky aspects to a setup like this. And the reason I'm showing you this is because it's a good example of why you should have a trading checklist on your screen. It helps you identify A+ setups, high probability setups versus low probability setups. Now, as I play price forward, I just want to clarify, you can still take these setups, but you have to understand that there is a reduced probability of success. Now, with this one in particular, it happened to be a win. But the question is, would it be a win that you'd feel good about? For me personally, that answer would be no. I didn't personally take this trade. Some of my community members did, and thankfully they were successful with it. But I always remind everybody to not grow accustomed to bad habits. The reason we have this checklist is to enable you to have the best possible setups. It's a constant reminder in your face at all times to only take the best possible setups. So if you go against your own confluences and you end up winning, well, maybe that was just luck. And then if you go against your confluences and have a loss, you're going to be pretty upset about it. So it's better off to just stick to your plan. Now that I've showed you this higher time frame example as well, I want to get into some lower time frame stuff. So I think I mentioned at the beginning of the video, my higher time frame style of trading is always executing trades on the 4-hour time frame. Now, if I want to be a little more active, I drop down to the 15-minute time frame and take trades there. Based on the exact same strategy, the exact same entry criteria, all I do is make one simple change. So I'm going to show you that right now. We're now on the 15-minute time frame. And we've actually stayed with Euro USD this time because there was a 15-minute entry opportunity shortly after that swing trade that I just showed you. That position is way back here. And what happened on the 4-hour time frame when that position came to completion is that we actually purged liquidity from this major high right here. And instead of breaking through with candle bodies, we closed with a wick and a rejection to the downside. So that prompted me to look for short opportunities. Now, going back to the 15-minute time frame, I want to explain that short opportunity. So first things first, now that I'm executing on the lower time frame, I'm going to open up my indicator and go down to the higher time frame settings right here, the trading panel. It says show higher time frame. I'm going to change my higher time frame from the daily down to the 4-hour. Okay, so just to clarify, when I'm swing trading on the 4-hour time frame, I use the daily time frame as a higher time frame alignment for confluence. When I'm executing 15-minute time frame trades, I shift my higher time frame bias from the daily down to the 4-hour. I find that these 3 time frames pair very nicely together. So the daily, the 4-hour, and the 15-minute. So now that I've shifted my higher time frame to the 4-hour, it's showing that the 4-hour is currently at a premium. We've started to see clear bearish movement to the downside. Bearish structure is forming. Now, one thing that you can do to even further drill this in is open up the Currency Pros indicator settings and check this little box here that says show higher high, lower low text. So let's enable that and see what happens. Now, on top of the structure indicators, you're going to now see the lettering as well. This can really help you differentiate from bullish and bearish market structure. So as you can see, we're starting to see lower highs, lower lows, lower highs, lower lows, etc. Now, this whole bit of price action here was quite choppy. There was no fair value gaps to pay attention to. And then we got this big expansion to the downside right here that left behind a fair value gap. So let me zoom in a little bit closer and we'll get a better look at this trade setup. So back to the checklist. We've already established that we now have higher time frame alignment because we're selling when the higher time frame is in premium. So we know that we're aligned and we're not going against the trend. So I'm going to scroll down to the checklist and I'm going to check HTF alignment, higher time frame alignment. Now, unfortunately, I'm going to have to leave the next piece of criteria still deselected because we don't have a liquidity grab here. Now, like I said, a liquidity grab is basically a false break of structure. So we'd want to see this high purging liquidity from a previous high. We don't see that here. And even going back further, this major high up here didn't actually surpass this one. So we don't have any valid liquidity grab here, although you could argue that the major high that was identified on the 4-hour time frame was the liquidity sweep. You could definitely argue that point. This one right here. Let me just annotate it for you guys so we're all on the same page. So this technically is a liquidity sweep, but for the sake of transparency, I'm going to keep it deselected because technically within the recent price action that we're paying attention to, there was no valid liquidity sweep. So I'm just going to delete these arrows and we'll move on with the rest of the checklist. So do we have a break of structure and imbalance? Yes, we do. The indicator is showing us that very definitively. We have a clear break of structure right here. So as you can see, this lower low that was printed was clearly violated by this massive bearish move here. That is the break of structure. There's no question about it. And that break of structure, thankfully, left behind this massive fair value gap. Now, once again, I'd rather not get into the semantics of why these fair value gaps appear on the chart. What we do know is that price likes to react from them. So as soon as we can identify them, this is the pattern that signifies a potential trading opportunity. This gap in price was left behind as price was trading aggressively to the downside. Now, we don't enter as price is trading to the downside. That would be extremely risky. This strategy is based on patiently waiting for the retracement back into our area of interest. Now you can see with this retracement here, price almost got towards my 71% level, but not quite. It started trading back to the downside. So at this point, it looks like a missed opportunity. However, price kind of bottomed out here and didn't actually take out this low, printing a new lower low. So we didn't see a push to the downside, printing a new low. Instead, price failed to break that low and started retracing back upwards again. Now, enough rambling, let me just play price forward and you can all see how this one played out. As you can see, very minimal drawdown, again, almost non-existent. Euro USD is very nice for that. And it very quickly went towards the final take profit target. I hope you're starting to see why I like this 71% level. It often garners a reaction just like that with very minimal drawdown. Of course, it's not always perfect and textbook like this. These are examples from the past week. And it's just been a great week in the market, thankfully. But don't get me wrong, it's not always like this. Sometimes there's a bit of drawdown. It all depends on the trade setup. Each one is different. Now, let me show you all another 15-minute example of a trade that I took this past week, just to really solidify this concept in your minds. And afterwards, I'm going to give you all some more tips and tricks to better utilize this strategy. All right, so here we are on GBP CAD, again on the 15-minute time frame. So as I said in the beginning of this video, this strategy is able to be utilized by swing traders, day traders, and even scalpers. If you'd like to go beyond these 3 time frames that I recommend, you could also pair the 1 hour time frame with the 5-minute time frame. I find that to be a really good lower time frame execution model. I would not recommend going beneath that. So keep that in mind if you'd like a little more frequency than I'm showing you here. But I digress. Let's get into this trade setup on GBP CAD. So this is another imperfect setup that I'd like to show you. Like I said before, not all trades are as textbook as those Euro USD ones. Sometimes they're a little bit ugly, but as you gain experience with this strategy and trading in the markets in general, you'll start to develop some intuition. And at that point, you'll be able to use discretion in your favor. So let's take a closer look at this setup. Unfortunately, we do have a negative confluence here, and that would be that we don't have higher time frame alignment. The 4 hour is showing to be at a discount. Now let's quickly toggle to the 4 hour time frame so I can show you what that means. Basically, we are very overextended to the downside on the 4 hour time frame. Now, if this is the current range that we're looking at, we are obviously in the lower portion of that range. So we're well beneath the 50% mark of this trading range. If we were above the 50% mark, it would obviously be at a premium. If we're below the 50%, we are trading at a discount. So once again, that is a negative confluence. Let's go back to the 15-minute time frame, and I'm going to pull up the indicator settings, and we're going to just deselect that item from the checklist. So let's go ahead and do that. And you'll see on the top right of the screen, there's now a red X next to the HTF alignment. Now, next up is a liquidity sweep. We actually do have a liquidity sweep here. It's a little bit too tight for the indicator to identify. Maybe I could adjust my structure settings within the indicator and it would come up, but for the sake of simplicity, let's just keep going. So this here is the liquidity sweep. Our indicator is paying attention to more significant structure to the left, which is a good thing. But this is a valid liquidity sweep here because it was a high that was printed, and price, instead of closing above it with strong candle bodies, we just wicked out here and quickly rejected to the downside, creating a shift in structure. Now that shift in structure is identified right here as BOS for a break of structure. Before we move on here, I want to clarify something. There's a lot of confusion between these different terminologies like market structure shift, change of character, break of structure. Now people are starting to say change in state of delivery. Every few weeks there's going to be something new. That's just the nature of this ridiculous industry on the internet. But the reality is that they're all the same thing. It's all a violation of market structure. And that's why I chose to ditch all of those other terms and just stick with break of structure. What this does is simplify the process, especially for beginners, but even for an experienced trader like myself, it just complicates the decision-making process to be focused on so many different terminologies, so many different variables. Just call it what it is. It's a break of structure. So as I said, we had that liquidity sweep at the high right here, and then a massive shift in structure to the downside, which is really nice to see. and we saw multiple fair value gaps being printed. We can see 3 right here within this range alone. So we've identified that liquidity sweep. Let me open up the checklist once again and check that box off, and we should see a trade score now of 75. So we do have the break of structure and imbalance, of course. Now, moving on to the 71% retracement, unfortunately, it does not land on a fair value gap this time. So does that invalidate the trade idea? No, it certainly does not. Does it lower the probability of success? Yes, it does, unfortunately. That doesn't mean that the trade can't work out, but it does mean that basically you have to mentally prepare for a loss, and you have to gauge whether or not you're willing to risk capital on that opportunity or not. In this case, I was feeling confident about the direction of price here, so I did risk a little bit of capital, less than I would normally risk. So I'm proud of that. But as I mentioned before, with these fair value gaps or imbalances, it's a reaction point for price. It's almost like a magnet that pulls price into it, and then it sits there for a while and then typically reacts from it. So if there's fair value gaps above my entry point, what that tells me is that there is potential for drawdown. And you're going to see what I mean in just a second. So basically, as price is retracing upward, instead of just reacting to my entry and then trading down, what could very well happen is it'll just keep retracing until it fills this gap, and then keep retracing some more until it fills this gap, and then hopefully it would go in my favor at that point. So ideally, it's best to have the fair value gap at the entry, or in a selling scenario such as this, slightly below the entry. Now, thankfully, we do have a fair value gap here as well, so that's a nice confluence. But again, we have 2 that are above the entry, so that's a bit risky, but I was still willing to risk some capital on this trade. Now, let me play price forward on TradingView's replay mode, and I'll show you how this one panned out. So there you have it. You can see the Currency Pros indicator is now showing a new range with new fair value gaps, new break of structure, etc. It's very adaptive like that. But let's take a look at what happened with this setup actually. So it did exactly what I was just explaining. As you can see, it traded all the way up to here where that lower high annotation is printed. Now, if I just drag an arrow tool to the left, you'll see exactly where that reacted to. And that was the most extreme fair value gap within the bearish range, right? So this is a very important thing to keep in mind. Not every trade is going to be perfect. There will be some negative confluences. So I really hope you enjoyed these examples that I've shown you. I do want to make a few points about this strategy. One of the most common questions I get is about time frames and what assets to trade this strategy on. So in terms of time frames, I've shown you the 3 that I prefer, but these are customizable. You don't need to stick with these ones. This is just what I like to do. But I think in general, the topic of time frames is way too overcomplicated. As I bring down this list here, you're going to see how many time frames are really here. I can see why that would be confusing at first. I mean, first things first, you can disregard all of the seconds time frames. That's only for psychopaths. The minutes time frames, you know, the 1 minute, 2 minute, 3 minute, there's a lot of noise on those time frames. If you're a beginner trader, it would be best to ignore those. I really wouldn't recommend going any lower than the 5-minute time frame. That would be like a bare minimum for me if I were just getting started. Now, I know there's going to be a lot of people who disagree with me on that. A lot of people think that the 1-minute time frame is like the most efficient time frame and it shows you the real price action. I understand that sentiment, but there's no debate that for beginners, it can be very, very dangerous because you need to have a skilled, trained eye to know what you're looking for on, for example, a 1-minute time frame or a 30-second time frame. So for beginners, it's just not feasible. So like I said, bare minimum would be 5-minute time frame. Now, this is where people complicate the time frames. They think that there's some magical combination of 2 or 3 or 4 time frames. There really isn't. All that matters is that you have a lower time frame execution and a higher time frame to anchor your bias to. That's all that matters. And that's why it can be simplified into just 2 time frames. You could add a third if you want that extra layer of confidence, but in reality, 2 is all that's necessary. So I just personally find the 15-minute time frame and the 4-hour time frame to be a good combination. But you could also pair pretty much any of these together. If you're on the minutes time frames here in this category, just find any of the hourly time frames, the 1 hour, 2 hour, 3 hour, 4 hour, find which one resonates with you the most and just stick to it. Click the little star icon next to it so it's favorited on your chart and then just stick to it. Now, one other thing I'd like to mention is that if you're strictly a higher time frame trader, like a swing trader, you don't necessarily need more than 1 time frame. So for example, if you're executing trades on the 4-hour time frame, you could literally just stick to that time frame forever. You don't necessarily need a higher time frame confluence because you're already on a high time frame. The same thing goes for if you're a real swing trader executing trades on the daily time frame. The daily time frame shows you so much data, you don't need to gain any more context by going higher up. So I hope that cleared some things up for you. Now, the next thing I wanted to mention is assets. So the assets that you actually trade the strategy on. Let me just move my camera over here so I can discuss this. This is my Forex watch list. I also have gold at the very bottom here. Now, as you can see, I pretty much have all the majors and minors listed on my watch list here. This is another topic that is vastly overcomplicated by people on the internet for some reason. There seems to be a lot of confusion here. The majority of trading strategies work on every single asset. If you think about the strategy that I showed you today, the entire premise is buying low and selling high. Now, with that being said, there is no market that it wouldn't work on. It can work on crypto, it can work on commodities, it can work with indices, it can of course work with Forex, which is what I most utilize it on. So there is not some magical asset that you need to stick to. Everybody always asks me, what is the best performing pair? Which pair should I focus on the most? And the problem with that question is that even if I answered you, it could change a few months from now. So all of these assets here, they go through seasons basically. 1 year, the Australian dollar and Canadian dollar Forex pair could be the best performing pair I've ever seen in my career. And then literally a few months later, it could be providing absolutely no opportunities whatsoever. This happens quite often. Look at AUD/JPY, for example. From a higher time frame perspective, this pair has been doing absolutely nothing for quite some time. It's been very choppy, but in the past, I remember even last year, this was the best performing currency pair on my watch list. So things change very quickly in the market, especially when there's so many geopolitical events happening in the world, so much controversy, so much uncertainty. And keep in mind, these Forex assets are based on currencies of countries. So that's something to keep in mind. There is no best asset to trade. And even if you think there is, that could change very soon, which is why I like to keep this large list of assets. Number one, because I'm predominantly a swing trader. And when you're swing trading, you really only get a few opportunities per month. So you need to monitor a large list of assets to trade because the opportunities on each asset are few and far between. However, if you are predominantly a day trader executing on lower time frames, you really only need like 3 to 5 assets. So you could maybe stick to the major ones if you'd like, or just trade gold. There's plenty of opportunities on gold, or basically any of the indexes like the S&P 500 or NASDAQ. But the main point I'm trying to get across here is that I don't want you to overcomplicate this because there is opportunity on all of these currency pairs. At the end of the day, it's all about what resonates with you. So I hope by this point in the video, you've understood why I call this my hybrid trading model, because it really is applicable to any time frame and any style of trader. I've often bounced back and forth between swing trading and day trading, and I do that based on how the market is performing. So for example, in 2025, for the past few months anyways, swing trading has been quite difficult because there's been a lot of consolidation on the higher time frames. Things haven't been moving much, and if they have, it's been mostly sideways. So my swing trading portfolio has been pretty inactive. And when things like that happen, I shift my focus to the lower time frames. So lately I've been trading a lot on the 15-minute time frame, using the 4-hour time frame as my higher time frame anchor. And that allows me to be more active during slow periods of time. But I knew that it was important to me to have a strategy dynamic enough to shift back and forth between those two styles. I don't want to only call myself a swing trader for the rest of my life and be stuck to that. I want to be adaptive because I have the skill to make money in any market conditions. I've been doing this for a very long time, and I take pride in the fact that I've been through a lot in the market. So I don't need to stick to one specific facet. But with that being said, if I had multiple different strategies, it would be very hard to bounce back and forth based on market conditions. So I made sure through forward testing and extensive back testing that this strategy that I've shown you here today with this extremely simplistic checklist to follow is very dynamic and adaptable to anything that's going on in the world. Regardless of whether or not countries are at war or trade deals are being negotiated and everybody's kind of in limbo for some reason, there is still opportunity. Whether it be on the higher time frames or the very low time frames, there is opportunity almost every day in the market. So I encourage you all watching this video to go and backtest this yourself. There's plenty of incredible backtesting tools available where you can gather decades of data very quickly. I would also encourage you to test this strategy in real time on a demo account. Do that until you get comfortable with it. You can see how it performs on your own, and you can really see if it resonates with you. Now, I'd like to also say the majority of strategies that exist, whether it be support and resistance, breakout strategies, Fibonacci-based strategies, smart money concepts, they actually all work. But what makes sense to one person might not make sense to another person. And that's why you see such a divide in this space of trading on the internet. Everybody thinks that their strategy is the best way to make money. And that's it. anybody who does anything differently is wrong and they're not as skilled and they don't know what they're doing. They don't know what they're talking about. I assure you guys, once you've been doing this for long enough, you'll start to realize there's hundreds of different ways to make money in these markets, and there's not necessarily a right way. There's only a right way for you. So like I said, if this strategy resonates with you, if the things I talked about today make sense to you, then by all means, go test it out for yourself and let me know down in the comments below how it worked for you. And I just want to leave you all with one quick message before I end this video. I want to remind you that this is not a way to get rich quick. This is something that you need to take very, very seriously as you would a career. And you basically need to prepare yourself as if you were going to college in order to learn these things. It took me a good 2 or 3 years before I finally started to grasp these types of concepts and apply it in real time. Some people happen to do it much faster. Some people take much longer. And that's okay. You're on your own path. You don't need to worry about anybody else. Don't let social media make you feel like you're behind. Just because some other 19-year-old has a Lamborghini, you're on a different path. You're on your own path, and you need to do things at your own pace. One common problem that I see amongst so many traders is that there will be a bad period of time in their trading strategy based on maybe market conditions or things that are going on in their personal lives, whatever the case may be. They go through a rough period of time and then all of a sudden think that they need to shake things up and find a different strategy. If you fall into that trap, all you're doing is prolonging your success. You need to stick with a proven system, and you need to stick with it long enough to actually see it play out in different market conditions. There's no strategy that's going to make you insanely rich within a few months. You're not going to be passing prop firm challenges every single month without fail. You're not going to be getting payouts every single month without fail. There are going to be a lot of peaks and valleys. But if you stick to one system and follow a checklist such as this, so that you know your entry criteria and you know you're entering good trades, then those peaks and valleys, if you zoom out, will be part of an uptrend. It'll be part of a very large uptrend. And all you have to do is be patient and let that trend play out over time. I want to thank you all for watching this video. I hope you all gained a tremendous amount of value from it. That is always my goal when I post a video on YouTube, but this isn't just about views and numbers for me. I want you guys to be able to come back to these videos a few months down the line or a year down the line and say, all right, this really worked for me. This clicked, and I'm finally on a path to success. So once again, thank you all so much for watching this video. If you haven't already, make sure to like the video and subscribe to my channel. I will gladly continue posting videos just like this to further nail down this easy, simplistic strategy that anybody can do. Once again, thank you all for taking the time to watch this video, and I'll talk to you all soon.